Welcome back to Higher Exchanges. I'm your host, Jesse Redmond, Head of Investor Relations and Business Development at Leaf Brands. I am back once again with Morgan Paxia. He is the co-founder of Poseidon. Morgan, what's going on, man?
Well, I'm back from about 2 weeks of East Coast travel, so my hair's a little long, and but good to be back in lovely San Diego and chatting today about what's cooking in the sector. How are you doing?
I'm good. I got a fresh haircut yesterday. My girlfriend's a hairstylist, so I'm getting haircuts on the regular, so I feel well groomed. I'm It's my second podcast of the day. Technically, my third podcast because I recorded the first one twice. So I'm about 90 minutes into recording podcasts today, which is good and bad. I feel warmed up, but feel a little bit tired. But yeah, overall, man, I feel like I'm doing pretty well. I think you and I talked we talk on the regular, but we had a conversation 6 or 8 weeks ago about maybe 8 weeks ago about it being a tough environment, interest being low, things feeling stagnant. And yeah, it definitely feels like there's a little bit more energy in the space. So we'll see what happens. But I'm grateful for what feels like positive momentum and some more interest, I would say.
Yeah, I mean, this summer's been, which true to form in cannabis, anything but a dull time. I mean, I know we did talk about it, felt like a low point, but for some reason, summertime things seem to percolate up, and the summer's been like that. A lot of tension out there,
Oh
a lot
God.
of like visceralness. It's nasty, but there does seem like there's some new people coming around. I don't know because they're like playing with the charts and stuff like that, and
Oh yeah.
I see a lot of that. But
Yeah, we're short on, we're talking just before the show started about which institutional investors are left. And we're light on institutional investors and we're light on smart voices in the space. Once in a while we get a new voice. We had, what was it, about a year ago? Remember our friend Shardy B?
yes,
So yeah, yeah, people like her come in, and then we've had some new voices, which I won't call out by name, that I think are ruffling some feathers, and maybe not the voices all of us would have hoped for. So yeah, looking forward to fresh capital coming into the space to drive some opportunities, but also just some new voices and more intelligent takes. 'Cause I think we're very very low on those at this point.
yes, and some fresh energy.
For
You
sure.
know,
Yeah. Yeah.
just for everything you just said, but just bringing some new life to the space is would be fantastic to see. And I think it's interesting as we're seeing some movement again on the private side, from large strategics. They are doing things; they just don't make it into the headlines that everybody gets to read about and act upon with public companies. But they're still moving, and these are big groups. Like I can't name them, but they're doing things. So they're not, they're not waiting for a catalyst. They just see some good opportunities and thinking about it in the next 10, 20 years and see how their business is being negatively impacted. So they're choosing to get in versus fight it. So um, that's
When
good.
I hear you say that, what comes to mind are things like alcohol, tobacco, pharma, probably not CPG. Am I on the kind of the right track there?
Alcohol, tobacco. I haven't seen pharma at all.
Yeah.
Not in the US. It seems like they are more comfortable ex-US.
Yeah.
Same with CPG, but alcohol and tobacco. I think alcohol just is the most obviously impacted. Tobacco, I think, are just seeing shelf space opportunity, and they
Yeah.
want to keep filling it with everything they can to keep their shelf space.
Speaking of alcohol, have you been consuming any cannabis beverages lately?
Still senoritas. I got to get myself some ranch water, but I'm a little backed up right now, so I got to work through some inventory. But I definitely want to try it. I like ranch water in general, so it sounds like a fun flavor. It seems like Ben
Yeah.
likes it a lot. So,
Yeah.
how about
Yeah, those are good
I know
drinks.
you. Yeah, I know you're a huge beverage guy.
Oh, I'm
So I
huge, man.
mean,
I
huge.
love them
So
so much that last time I went out to our farm, out at Salisbury Canyon Ranch, I brought 16 beverages out there for the fellows at the ranch just because I wanna share them at Morgan because I enjoy them so much.
so you just gotta give them to all your friends. Did you see before we get into it? You see the all the craziness with that drippy THC beverage.
I don't think so.
So I think they're
Oh,
trying to
oh,
play it
yeah,
off as
okay.
like a
Yeah,
marketing
I think I know where
ploy.
you're going. Yeah, yeah.
Yeah, and how they were like, "Oh, we're gonna be served on Virgin Atlantic airplanes," and and then that was quickly refuted, but didn't stop the space from getting whipped up pretty fast.
I always
So,
actually think it's about something different. Did you see? I think it was Breezy, maybe, where
oh, the
the
CEO.
founder, the CEO, was like naked on a Florida beach, like early in the morning or something like that, in inappropriate time.
Well, I read that and I was like, so what? It's Florida. I mean, is that
Yeah,
not a normal thing?
yeah, that's standard. Yeah.
Yeah,
Well, cool, man. Let's jump into the agenda a bit. We started off talking a
yeah.
little bit about how it feels like the environment is improving from a sentiment basis, and nothing like higher prices to improve sentiment. And I did a little bit of work before the show to put together some info on the kind of momentum we've been seeing. And if you look back, Morgan, I think it was just 63 days ago. MSOS was at $2.06, and now it's at $3.37. I'm sorry, 40. Start over. That was 45 days ago. MSOS was at $2.06. Now it's at $3.37. So a 63% increase over that period. So pretty significant appreciation there. I don't know if you've been following the inflows, Morgan, but I saw that Jane
Mhm.
posted last night that we've seen almost 33 million in inflows over the past 10 market days. So I believe that's 10, I think it's 10 straight days of inflows, if I remember correctly, and 33 million bucks. I'm trying to think the last time we had this kind of momentum. Do you remember? Was there a time last year we had where we had this big of a push? Maybe when the DEA
Yeah, I
came
was
out.
gonna say, I
Yeah.
think that was 2 years ago though
Was it
that we
okay?
had. Yeah. Um, or I mean, shit, maybe even 3 years ago. Um, there are these periods of time where I think and I saw Ben Kovler asking, like, where's this money coming from? Is it genuinely inflows or is it just, shorts pulling back a little bit and it forces a create and it makes the illusion of inflows.
Hmm.
And so, the big question that I think any of us have is this actually the turning point? Or is this just another one of these blips where you get this kind of unwind, stocks float up, and then the shorts reload, pressure back down, goes to new lows.
Yep.
And I think in the absence of any action, um, probably. I mean, until something changes, I don't know what's gonna, as we'll talk about in these cues, it's one thing for eventually stocks should follow earnings, and it actually has been, rightfully. When you think about some of these companies, they
Yep.
deserve to be severely down. Um, but I don't think it's true for all. But and as we talked about 2 weeks ago, is there going to be follow through in the near term, or are we still kind of in the teasing along cycle? And could we potentially be teased along for another year? And will these stocks hold up, or will they start to peter out? Because if there's not enough feeding of that teasing, will people continue to want to play?
Yeah. What I've
Only
been
time
seeing
will tell.
Yeah, what I've been seeing on my side in terms of the conversations I've been having, more leaf focused conversations, but some of the existing players that hadn't been putting money to work and seeing are either getting some fresh money to put to work, or some that had cash have been putting that to work. And so that's generated, I've been having more investor conversations, a lot more over the past month than in the prior couple months or so. So definitely seeing people, I think, take a harder look at us because we have some interesting things going on, but also I think people kind of poking their heads out and saying, hey, maybe it's time to put a little more capital to work. I can't think of someone that I totally didn't know before, but definitely some people I hadn't talked to in a while. So I think that's happening. And then I think more good people are trading names too. And
Mhm.
so, there's been some names like, Glass House, which has been, under, a lot of pressure. And so maybe some money moved out of that into some other things, or even people just shifting money around the tier ones or the top 10 type names. But if you look at the underlying volumes, those haven't been appreciating or go dearly as much as the changes you've seen in MSOS volumes.
I think Glasshouse might be the cue I'm most interested to actually listen to. I haven't listened to any of these calls, because I just find almost no value in dialing in and spending half hour, 45 minutes to an hour listening to. listening to the whatever they're saying. So, but I think I might tune in for that one just because it's like there's a lot going on there or not, right? And it's like, what will we learn? What will they be able to talk about? So that's why I'm genuinely very curious about that one. I think you're right though about it's kind of it feels like the investor dynamic or trading dynamic, however you play in the space, has changed a bit where everyone's kind of just conceded to the point that if you just want beta or just a quick play, you just MSOS or MSOX if you're really wanting to go for it. And then otherwise then it's really just want specific companies and that's it. Which I feel like that's more so than ever. Like I feel like before it was people were talking about like even like their own like mini uh vehicle, like a mini ETF where they were doing a basket. And I feel like that
Hmm.
basket's gotten a lot smaller, where it's like maybe one, two, three names if they're looking at doing something specific. Which I don't think there's anything wrong with that, other than managing your risk profile and all that blah blah disclaimer. But just because as these cues are showing, I mean the differentiation amongst them is becoming so much more. Like I remember we started talking about this a couple of years ago, but it's just ever apparent every single quarter now, more and more so.
Yep. Yeah, more dispersion in returns and performance. I was looking, looking back over the same period that MSOS has gone up so much, and you see, over that period, you see some pretty good dispersion. Juice usually up 117%. Curaleaf's doubled up 100%. TerraSen's up 78%. I'm sorry. I keep screwing up these time frames, guys. I really apologize. I'm looking now over the last month rather than 45 days. So let me reframe that. So over the last month, MSOS is up 38%, Jushi up 117%, Curaleaf up 100%, TerraSend up 78%, Cannabis up 89%. So all of those names have more than doubled the return of MSOS. If you look on the other side of that, in terms of the ones that have been lagging, you have IIPR down 17% over that period. Glasshouse down 14%, Weed Maps about flat, and then you have a whole bunch of names that are up somewhere in the kind of mid 30s or so. So I feel like these names used to be more tightly correlated, but even within that MSOS basket of the top 5 or 10 names, you're starting to see pretty good dispersion with some names more than doubling, while some others are up quote just 20 or 30%, which are still good returns, but a lot more dispersion than we used to see a few years ago.
And let's not forget AYR down 99% in that
Yeah,
time,
yeah.
which was uh, was that a top 10 holding in MSOS?
I suspect. Yeah, it had definitely between 5 and 10. I think it's fluctuated. It fluctuated a bit over the last couple of years, and yeah, let's use that as a point to transition there, Morgan. I think
Mm.
that's an interesting one to talk to, both high level in terms of kind of lessons learned, but also kind of how it's going to shake out. Like who's going to own the assets? What do the creditors get? What do the equity investors get? Because man, I remember these conversations we were having probably started hard about a year ago with some of these names like the forefronts of the world, where you would see restructurings going on, where I just felt like the retail investor, at least the less sophisticated retail investors, sometimes didn't realize that the common, was already dead because of the amount of debt that it had. And AYR certainly, was at risk of that, and it kind of manifested. So why don't you kind of take us through high level what happened, Morgan, and then we can
Mhm.
each got to give a take on lessons learned here.
Yeah. So AYR, if you look back over their history, they were not unlike some of the way the other MSOs constructed themselves, heavily uh, built by acquisition. And they did a lot of acquisitions. They took on a lot of debt to to do these acquisitions. Um, and and while they were doing all these acquisitions and taking a lot of the debt, I think what was becoming more clear versus some of these others was they were still kind of going towards the proverbial cliff and not trying to right size operations. And so, what happens when you just keep taking on more debt and you're not improving your cost side of the equation is the debt service. So, the debt levels are growing and the debt service is becoming just untenable. You just
Mhm.
can't if you don't have if your cash flows are not commensurate with the debt you're taking on. It's only a matter of time. Um, and so I think they had amassed about, was it, they peaked over 900 million of liabilities. And then going into this year, they had in the, you know, 30, 40 million of cash. So, going into this year, it seemed like the probability of pulling out of that were declining. Um, and again, I say they weren't the only ones to do this. I think they were just there was just some flaws or unwillingness to do certain things, and it might not have been like there were some good people there that we're friends with that certainly wanted to see things happen and pushing for change but couldn't do that. In some ways, it reminds me a lot of the State House situation, where it was very much the same, where there was people pushing for change and just an unwillingness to do so, and it's only a matter of time. So, I think some of the red flags that started to pop up to us were obviously a lot of CEO turnover. Anytime there's a lot of that, you just have to ask what's going on. Obviously, CFOs fall into that bucket. But when it became pretty clear was, what was it, May 30th, they had to delay their first quarter earnings because they were in ongoing creditor negotiations and initiating a strategic review process.
Hmm.
So, strategic review process is one thing, companies do that, but when you have a super impaired balance sheet, I see that as like a pretty big red flag. And then those delays continued, right? They continued to delay because they were saying there were ongoing creditor negotiations. And then when June 30th hit, and they didn't make their interest payment, very highly likely of something severe having to happen. And then on 7/30, on July 30th, they entered into this what's called a restructuring support agreement, where the supermajority of the note holders were with the supermajority of the note holders. And what does that mean? Is basically they become the owners of the assets, right?
Hmm.
Because the debt is a senior position, so they become the owners of the assets, and specifically the owners of the assets that they wanted, and then they choose what they're liquidating from there. So this is like a almost like a very note holder, a cleaner way of, like, since we don't have bankruptcy anyway, but this was a way that they just basically took over the company, and then anything they liquidate, they get paid. So the equity is worthless, completely worthless.
Yeah, so let's
And
stop there for a second, Morgan.
yeah,
So the ones that are so there's gonna be a credit bid process, right?
there will be a credit bid process. It's going to be very hard
For
for anyone to come over the top of the note holders.
Yes, but in that credit bid process, the assets that are in that pool, my understanding, are Florida, Pennsylvania, New Jersey, Ohio, Nevada, and Virginia.
Mhm.
And
That sounds good.
and those will move into new entity fully owned by the note holders. The remaining legacy company and the assets nobody wants will be wound down and liquidated. And that goes back to the common. Is that right, Morgan?
It goes back to the note holders.
Oh, even that
Yeah,
piece does. Okay.
yeah, because they're the first ones to get repaid. Common gets nothing.
Okay, so
Um,
if they get repaid, there's excess, then that piece of the other assets could trickle down if there's leftovers.
right, but just understanding the amount of debt they have,
Yeah,
it's almost impossible to imagine a scenario where there's that much asset value, especially in this environment.
yep,
Where just people are not paying for assets, especially not these low quality assets that they've identified that they don't even necessarily want. They're not going to get much bid for those. Um, Pennies on the dollar, not dollar. One thing I'm not clear on is what happens to their uncertain tax policy
yes,
liability,
yeah,
and who assumes those. If they're able to, in this restructuring support agreement, are they able to shed tax liability because of the restructuring? I've seen some chatter back and forth out there about differing opinions on that. I can't say I have any idea,
yeah,
but I think that is a big piece to understand, because if this works this way, I assume note holders in other companies that are similarly troubled balance sheets could follow suit, because it's a way that they get to take over these assets, wipe out the equity, and then they take over assets, as the sole owners.
So the creditors end up with the choice assets in a debt-free structure?
Right. Because it's their debt.
Yep.
So they've
Uh,
equitized their debt.
and there's two, are there just two note holders or they're just two big ones? Do you recall the structure there?
I don't. I mean, to get to super majority, I'm sure there were some large chunky note holders that were able to pull along the rest to do that.
Yeah, they always say credit guys are the smartest in the room, and that looks like this how this one's playing out.
Well, and in this instance, some of those chunky credit guys were also the major equity funders of the business, so they were on both sides of the table and able to secure themselves via their debt side.
Mhm.
And I do say that's not uncommon in this space. There are other names that have similar executives, founders that are, and especially the last few years, have been putting their capital not into their common, but into the debt. So they're
Yes.
protecting themselves in this kind of situation.
We had a conversation about a top 10-ish name, I think that did that 6 months or a year ago. I don't know if you remember the conversation.
Hmm.
Yeah. Um,
Yeah.
it's so when I think about AYR, I think you did a good job framing it off the top, Morgan. Think of them as being one of the more aggressive, MSOs back in the day, and that they were, paying premium prices for what they perceived as premium assets. They had, high SG&A, and I think that they were generally too. We've all been too optimistic, right? Like, let me raise my hand and say, certainly been too optimistic. But there's levels to being too optimistic, and I think AYR was one of the most optimistic firms, especially the Sandelman regime, and maybe that things toned down a bit and got a bit more conservative when Gobert was there, and now we have the new leadership. But I think in general, AYR spent a lot, period, as a company, and spent a lot acquiring assets, spent a lot building the business. And I think they did so because they had some sort of confidence about how things were going to change, right? And
Hmm.
so one of the conversations, I feel like this was an 18 months ago, roughly, conversation we always had was on these reform dependent versus reform independent names. AYR clearly went in that reform dependent bucket, which we didn't know, is that a good or a bad thing, right? If reform happened, that could have turned out to been a good thing because it had a lot of leverage to reform. But the reform fell on two sides for AYR. It fell on the federal reform side, which most cannabis companies are dependent on federal reform in some way to remove that 280E liability. Safe banking, plug your ears, Morgan, could help out as well. But generally, federal reform, some will benefit more than others, but I think most are pretty subject to that. So another level to the reform dependency, which is the state, reform at the state level. And I went back and looked, and David Gubert, one of the former CEOs, said in March 2024, with only 15 of AYR's 91 retail stores operating in adult use markets today, we believe AYR is the highest relative exposure of any MSO to recreational opportunities on the horizon in Ohio, Florida, and Pennsylvania.
Hmm.
So Florida didn't flip. And I think at that point, that was really the nail in the coffin for AYR. Pennsylvania, we're still waiting on. And then the third one, David mentioned that quote, is Ohio, which has been a disappointment. So
Right.
I would say, Morgan, that like to me, one of the lessons learned from the AYR experience is, and I think we knew this, but to see it happen and make it real, gives it a little more tangible feel. It really exhibits the risk of these reform dependent businesses where it's sexy to say you're in all these limited license states, you've stacked these assets. And when this flips, this is going to be this huge opportunity. But two things. One is things always take longer in cannabis and always are more expensive, but almost always take longer in cannabis than you'd expect. Case with Florida, case with Pennsylvania. And then in the case of Ohio, sometimes you get these flips and we're too optimistic about how much that is going to change things. I don't think a good Ohio or even, an excellent Ohio changes this AYR equation. I think it was really, if you're to rank order it, Florida's, the vast, vast majority, Pennsylvania after that. And I would probably say then Ohio. But I would say the lesson that I take from it, Morgan, is, partially about the general aggressiveness and, broadly speaking, being more conservative in cannabis has been the right way to go. But especially the lesson that I'll take back is, this notion of reform dependence and really being cognizant that because of that, you could end up in a common with a zero like this.
Yeah. 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 I mean, I think one lesson that comes to mind too, to your point about being so aggressive on acquisitions, acquisitions are hard to get it right from a valuation perspective. We certainly went through a different cycle, so everyone that was participating in a different part of the cycle, hindsight says they overpaid, but you couldn't do anything different at that time if you were being aggressive, because that was just the dynamic then. But so that's step one, is what you pay, price, but then the second step is how good you are at operationalizing and really gaining the integration efficiencies. And when you're doing it so much, we've seen companies have taken years of really trying to do a lot of work in trying to operationalize and gain those efficiencies, and they've had to take huge write downs from overpaying on things like, they've taken a lot of medicine. So you imagine when they do come back to the acquisition well, it's going to be a much slower pace, because they don't want to end up doing that same thing all over again, especially if it's similar management are still in place. But acquisitions are hard. I think that's just a lesson that we have to remember. We do them internally with portfolio companies, but we're super judicious because we know it can blow up a company pretty fast. So you just got to be careful. Um, the other thing I wanted to mention, lessons learned, uh, is looking at the management of these companies, governance, um, how you can effectively put in controls and accountability um, to managing. These are public companies; they're supposed to have a fiduciary duty, but when management feels unaligned, I know most people don't really care in the space. I do, because you just see the pain that can happen from it. And this one has always kind of been in our bucket of like, we just stay away from it. It was always just kind of like a couldn't get comfortable. And like I remember our last conversation when we had whoever the CEO was at the time, still didn't seem like he was being sober about the situation. Like there was still a lot of confidence, unfound confidence, I would say, about the reality of the situation. And then he bounced out and
Yep.
left it to the next guy. But
Yep.
so management matters. I think people matter so much in general in business, and especially in this industry, and especially when you have tough balance sheets and tough regulatory dynamics, all these challenges we have. I don't think there are many that are truly cut out to get through all of that, and especially when you have unfound confidence. That's just concerning, or just be aware. I was always surprised too with how much people. I mean, maybe because of that confidence, people really just thought like really bought into the story. Because I mean, the liquidity in that name and the confidence in that name, people really seem to love it. And you looked at forget about the enterprise value, just the market cap relative to some of the others, and it was a head scratcher. But people, so I guess they were good at telling a good story.
Yeah, I think that's worth highlighting there. And what I always refer to that as is the qualitative assessment of the management team. And I think back to 2003. Yes, I am that old. Um, and I was leaving Fisher Investments in San Francisco, which is a more fundamental firm, and I went to become co-portfolio manager of a hedge fund. It was a fund of funds, so we were allocating capital to two external managers, and they were quantitative strategies. So it was a fund of quantitative alpha return hedge fund strategies. So like the Millenniums, Caxtons, the Renaissance, the Tudors, the Moores. Those were some of the big names back in the day in the quant space. And I remember looking at the deck and talking to the founder of the firm. And these were, computer-driven quantitative algorithmic strategies. And still, even running quant strategies, number one in terms of what we do in due diligence here is a qualitative assessment of the portfolio management team. Because in that case, they're the ones that built the algorithms. They're the ones that are updating the algorithms. They're the ones seeing if they're decaying. They're the ones making all the changes. And so even in quant strategies that make systematic trading decisions, still number one was qualitative assessment of the people involved, because he wanted to know, can they continue to evolve the strategy? And I would say exact same thing here. We hear people talk about that with TerraSun with Jason and Ziad, who are I think viewed as some of the sharper operators in the space. People cringe when you say bet on the jockey, not the horse, but it's just all different ways of saying the same things, which is that the qualitative assessment of the management team is absolutely critical. I don't argue in an emerging industry with smaller growth type companies, like we have today in cannabis. I think it's just absolutely crucial. And yeah, and I would say over and over, AYR was not one of the ones you'd rank the strongest in terms of the qualitative assessment of the management team, but also just the consistency of leadership was a problem as well.
Yeah. Yeah. I mean, I think it's, just another lesson is balance sheets matter. That was my favorite takeaway from the Berkshire meeting this year was that, what did Warren Buffett say he likes to start with is a balance sheet.
Yeah.
So if you just did that, you wouldn't have to do any more work on this name and it'd just be like, that's just a pass.
Yeah. Yeah.
When you have over 900 million of liabilities and rapidly dwindling cash, it's just easy to just say, no, thanks.
Yeah. Well, cool. Well, let's wrap up the AYR conversation and jump into earnings. I'll caveat, I was saying to this Morgan off camera, but I like to be transparent on camera as well. Sometimes when talking about the earnings, I don't feel quite as sharp on them as I used to be. Most of you know I used to be a cannabis analyst, and that was my job, was to follow all the earnings and companies. Now working for an operator, I literally do this, at night because all my days are tied up, focusing on leaf specific issues. So I'm going to do my best to sound sharp about earnings and get some good big picture takeaways from the quarter. But I just wanted to caveat, if you're like, hey, Jesse, you don't sound as smart as you used to, if I ever did sound smart, it's because I have a day job working for an operator that takes more than all of my time. But with that caveat, I'm going to jump in and talk a little bit about Trulieve. And this is an interesting company, Morgan. So Florida focused, and you could have viewed them as so. I don't think they were dependent on Florida. Is a strong term because they're still posting pretty nice results amongst this group without Florida flipping adult use, but really one that had huge leverage to Florida. We saw from the Florida fallout that AYR that was kind of the nail in the AYR coffin. But Trulieve, I think continues to deliver better results than I would have expected. Combing through this quarter, they beat street estimates on adjusted EBITDA, which, adjusted EBITDA has its flaws. I know that, but they did beat estimates on adjusted EBITDA for the 9th time in a row. And I think one thing maybe we'll see at the end of this, Morgan, is I think analyst estimates have gotten a little bit lower. So kind of foreshadow that now, but I think that, estimates are, getting to be more accurate, which is a great thing. Revenue about flat, 302 million, while margins remain best in class at over 60%. Obviously Florida, you have to be fully vertically integrated, which really helps in margins because they're capturing all parts of the supply chain there. So that's why their revenues continue, or their margin, continues to be so much higher and a real standout. 86 million in operating cash flow, 75 million in free cash flow. Cited retail traffic and unit sales were up, even as consumers traded down to value products. So I think that's another theme that started a couple of years ago when the wallet pressure started to increase and companies that were once premium only, like Verano, started to add value lines. I think Ascend did the same thing. Morgan has been doing real well. So I think we're seeing that more and more, people pushing towards the value products. Other thing I wrote down is wholesale grew 27% year over year, and the company continues to gain share in key markets like Florida and Pennsylvania. And when I cruise through the analyst estimates versus the results, revenue in line, beat on gross profit by a bit. That led to a small beat on gross margin, just by about 0.5%. Adjusted EBITDA, solid beat there, 111 versus 102, and then beat on cash flows as well. So I'll pause there for a second, Morgan. But overall, for Trulieve, I thought it looked like a pretty solid quarter.
Did you look at their? I was trying to do this for the names I'll be chatting about, but what's their current store count? Did you happen to pull that?
No. No, I have data on how many stores their beverages in, but I don't have a current store count on there, on them.
What did you think about for like when I was looking at their operating cash flow and things like that? Was their UTP,
Mhm.
or uncertain tax policy? Did you see how much they've built up this year?
No, didn't see how much it increased.
It's about 114 million.
Okay. Do I have that here? Nope. I don't have it in front of me.
I think it was 58 million in the second quarter. So I hope I'm not blending numbers with anybody else, but I'm pretty sure that was Trulieve. I didn't write my notes down for that one because I didn't cover it, or for today's conversation, but I think those numbers stood out because I was playing around with my spreadsheet about, do I put it in? Do I take it out? You know what I mean? Like, do I adjust operating cash flow and free cash flow? Because that's a huge number. And they're also, what do they do? 30 million of donations or, political
Yep.
contributions in the quarter. So, they're definitely still very much wanting to make Florida adult use with that kind of money. I mean, it's nowhere near what they were spending last year, but it still is a very healthy amount. Because that's like some of these guys, that's like 75% of their capex budgets or not, or even more. So
Yeah, I listened to the Curaleaf call this morning, and yeah, and Boris was mentioning, someone asked a question about Florida, and Boris said something to the effect of Kim was largely, handling that, checking with her.
yeah, yeah. So that's definitely an investment for the future if they can make it there, or it's a big cost that is taken away from shareholders to potentially grow a bigger business. Because to your point, I mean, I think for the quarter, I look at everything year over year. I don't really like sequential at all for our space because we have like a lot of weird stuff and timing of payments and all that stuff can really mess around sequentially. So I just do year over year. They were down. Did you say this already? They were down marginally year over year. The second
On,
quarter.
you say
Top
on
line.
revenue?
Yeah, top line.
Yeah. Let's see. So, yeah. So about flat on top line, adjusted EBITDA up 2%, gross margin up 70 basis points on the year over year. Sequentials, which we were talking about this offline, sequentials are tough because there can be cyclicality in businesses, especially in California. Q1 is always a lot stronger than Q2, so sequentials aren't the best comparison. Also, a lot of noise between quarters, so tend to look at the year over years. But in this case, the sequentials are about the same. Up, I think, 1% on revenue, up 2% adjusted EBITDA, and down just a little bit on margins. But basically, flattish across all metrics over the last quarter and over the last year. And unfortunately, that feels kind of good in cannabis, and we'll get it, which isn't what we want, in a growth industry. But compared to some of the other reports, flattish does not look bad in this environment.
Yeah, and I'd say a takeaway I had for them was looking at some of the remaining analyst coverage. Um, Actually took their top line for the year down a little bit, but operating cash flow up pretty decently.
Hmm.
And I thought that was interesting because the UTP, the uncertain tax policy, like that is what it is, right? So you can kind of put that aside. So so analysts are getting a little more optimistic about the cash generation there, um, by quite a bit. But top line number was only marginally taken down. So, um, but that tax balance, I think they're at, as of through the second quarter, almost at 560 million
Wow.
of unpaid taxes, for just the 280E stuff. Like I think everything else are just normal course paying, but just not just noting for the 280E bucket.
Yep. Other things, since we talked about beverages earlier, their onward and upward beverages are getting good traction. Cases sold up 300% versus the pilot launch, expanded to 157 total wine stores with multiple new flavors incoming. So they sound like they're fired up on the beverage side.
Yeah. Well, good. Um, Anything more on that, or should we jump over to the next one?
No, I think let's talk about GTI. I
Okay.
listened to that call as well, and yeah, excited to hear your thoughts since you have been a long time investor in GTI.
Long time.
A
Yeah.
lucky
So
long
top line,
time.
top line was up 4.7% year over year. I think that's puts it as like one of the reporting. That's the best top line we have seen year over year. With that said, they're still only expected to be marginally positive for the year top line. So really just kind of a flat top line year. Store count stood at store counts at 108, which has grown. I think they ended last year at like 101. So modest store growth, just being very mindful about their growth. Notably to me was operating cash flow. There's these, to your point, I've just even hidden adjusted EBITDA. I'm not even going to look at it anymore because I just don't even, it's just like so ridiculous. So I just won't even cover that in my little tracking spreadsheet. Operating cash flow is expected to grow 17% year over year. So even with that kind of flat top line, driving a lot of growth. Notably, the difference between them versus, as I was mentioning, with Trulieve, that is actually their top line or their operating cash flow is only expected to be 8.8%. Anyway, so back on GTI. So 17%, so driving a lot to the bottom line, which is great. I will just say for folks that do like the adjusted EBITDA, there is some noise around there with what they did with Incredibles, and there was like some other stuff, with how they sold that off to Agrify, and so there was like some things going on there. Obviously, they don't have any UTP. They're paying all their 280 taxes, so they have a zero balance there. Total debt for them is at 250 million, so reasonable, especially when they ended the quarter with 177 million cash. And this is after they bought back 24 million in stock in the quarter. So, just really solid. Their margins on, the operating cash flow margin for them, I have, what I consider the revenue to operating cash flow conversion, I would call it 20%. So that's, I think, is a really good metric. While they're driving some top line growth, they're still at 80 million expected CapEx for the year, which is flat year over year. Everyone else is, throttling back, it seems, quite a bit from what they were spending last year, while GTI is continuing to spend. So even with their CapEx spend in the quarter and stock buyback, they still had 177 million of cash. And then I think the big thing that got people really worked up is the announcement that they're not going to do quarterly conference calls anymore. And you were actually listening to this. So how did that come up, or how did that seem presented on the call?
It came up, if I recall, towards the end. And so taking a step back, when I look at GTI, sometimes I try to summarize things in a sentence or two for myself in my head, just to make sure I'm getting that big picture right. And I always thought about them as being the most consistent, but the least transparent operator. And so, I think back to when I was an analyst and I was trying to do some work on Maryland, when Maryland flipped adult use, and was trying to put together how much cultivation canopy space each operator had in Maryland, because it's easy to get the store count. It's harder to get the canopy, which might help inform, the wholesale decisions and vertical mixes and those sorts of things. So I was looking up all these, some people put it in their report, some people put it in their deck. With GTI, I was hunting through like newspaper articles, tried to find out how much canopy do they have in Maryland. And so I decided, after I couldn't find it, I'd shoot them an email, sent them an email, and got back, we don't disclose this information. And that's just one of many things with GTI where they're not industry leading in transparency. And I've talked about before, I remember in the hedge fund industry that it was always the top performers that often were less transparent, because they figured, I don't want to share my secrets and I don't need to share my secrets. So I'm just going to keep them to myself and let the results, speak for ourselves. And I always felt like that was kind of the vibe with GTI. They operated more like a premier hedge fund that was looking for big chunks of capital, big institutions, willing to have more sophisticated select conversations, but wanted to tell you as little as possible. And so I just view this as, I thought it was, I can't say I wasn't surprised at the time, but if you said, Jesse, there's one US cannabis company that's been doing earnings calls for, X number of years, and they're going to stop now, who would it be? I probably would have guessed them, just because that kind of fits what you see from them from a corporate culture and communication perspective. And so they said something to the effect of that for analysts, and I know they said larger investors or institutions, was something like that. We encourage you to reach out. And, I don't think things necessarily change much for them. If you're Aaron Gray, if you're Federico, if you're one of the handful of remaining cannabis analysts, I think you probably get the same information. If you're a large investor, you probably get the same information. I think the ones that felt offended, and I think it's fair, is the retail investor who might have a few $100,000 in GTI, or maybe it's even only $25,000, but to them that's a meaningful chunk of their portfolio. I totally get it. And so I think that, yeah, if I were a retail investor, I thought these calls aren't real transparent. You mentioned you didn't even listen, Morgan. There wasn't a heck of, I listen more for tone than I do for information, just to see what sentiment feels like and what they're optimistic about, what, where their inflections pick up on their voices. And so I would say GTI calls are generally, real high level and, highly scripted. Even in the Q&A, they tend to not, people give them specific questions. Sometimes they answer them more big picture. And so, all of that to say that I wasn't, I was surprised, but not surprised that GTI would be the one that did it. Some people were speculating, does this mean that GTI is thinking about going private? I don't have any knowledge or edge there. That would surprise me, but maybe that's a possibility. But yeah, so that's kind of my summary of it. Was it felt like they wanted to keep the lines of communication open, but I think from a capital perspective, they're most concerned with analyst coverage and big institutions, and less concerned with keeping the retail community up to speed.
Yeah. I mean, just I'm sure they looked at the amount of people dialing in too, and just
Hmm.
watching that decline for so long, and they were just like, just forget it. Like what? And I understand what you're saying, but I could just also understand from management's perspective where they're like, for a use of our time, if they're really not getting anybody here, then we'll just stay heads down and focus, and we'll have those one-off conversations as they come along. But to go through all that effort, and it's, you know, Ben and Anthony and those guys, I mean, they're big time Berkshire fans and followers, and
Yep.
Buffett, and those guys had always professed they don't want to listen to management, they don't want to listen to calls, they don't even want to have, like, there was a story about Warren Buffett had lunch with this one guy once upon a time and got totally turned off from the guy, and just from that conversation went back, sold all the stock, and it 10x from there. And so Charlie said, "No more lunches for Warren." So, so it's like you kind of wonder if these guys are taking a cue from them of like, if it's not, we're not really doing anything that's changing the dynamic. So let's just put it. And I don't think it's gone forever. I just think it's gone for now,
Yeah.
and
Yeah,
it'll
I
just
would
be
agree with
on
that. Yeah.
pause.
Yeah,
Yeah.
for sure. Yeah.
So I don't know. I didn't think anything. I didn't think any negativity from it. I find it interesting that people think that would be a cue that that they're going to do something like go private. I would highly doubt that has any correlation at all. Because what would they say on an earnings call that they would be able to say is something that they would have to disclose anyway. So there's nothing that would change from what they could talk about. Um, so yeah, to me it was a nothing burger. I know for some people they feel upset by it, but I don't need Ben to tell me everything's going to be okay to make me decide whether or not I want to continue to hold the stock or sell it. So
Well, cool. You want to transition into Curaleaf here?
sure.
Yeah, so this one, Morgan, I listened to this morning and certainly read over the results, and for sure a mixed quarter. And we'll talk about, it feels like there's really two different things going on with Curaleaf's business. And so with the mixed results, international sales were clearly the standout, smaller base, but up 60% year over year, which helped offset quite a bit of softness on the US side. EBITDA came in line, but gross margins, free cash flow missed the mark. Part of that due to investments they've been making in global markets and in hemp. And broadly, what I see with the Curaleaf business is, like I said, softness on one side, which is the U.S. I'm trying to look at so overall revenue year over year down 8%, international revenue up 62%, U.S. revenue down 14%. So again, US down 14, international up 62 year over year. That leads to 8% decline in revenue. So considerable softness in that US footprint versus some of the names where we're seeing more like flat results year over year. Analysts were too optimistic about this one, Morgan. Slight beat on revenue, missed on gross profit, led to a miss on gross margin, miss on adjusted EBITDA, miss on operating income, and I don't think there was a free cash flow number. It looks like they had minus 10 million on the, or 11 million or so on the free cash
Mhm.
flow. I don't think there was a number out there for that. But across the, what, 1, 2, 3, 4, 5 metrics I have in front of me, they beat on one, which is revenue, and missed on all of the others. So I looked through other things that I took away from the report, Morgan. Again, international, was the strong suit and really a focus, a lot on the call, both in the script and the questions. Key drivers there are expansion in Germany and the UK. They also have a new license in Turkey. And during the call, they talked about, their clearest growth channel being this international part. And also Morgan talked a little bit about the potential for a spinoff on the international side or the hemp side to unlock some value there. US revenue, I mentioned, declined 13.7% year over year, reflects ongoing saturation in pricing pressure across those markets. Margins under pressure, gross margins came in at 48.5, missing estimates, partially due to costs, partially due to pricing pressure. Hemp and international also dragged down margins by 340 basis points total. So again, strong revenue growth, but sounds like maybe not the best margins over there at this point. Cash flow, I mentioned, was weak. EBITDA was in line. Free cash flow was minus 10.8 million, which I've seen has been raising a bit of concern there. And then the last point I had on there, Morgan, was the potential for spinoffs unlocking some value. So management hinted at possibly spinning off the international business if U.S. reform lags, and same thing potentially on the hemp side of things. So I would say if Curaleaf was a U.S. only business, those would be super soft results. The international components seem to soften that blow a bit. Would be my takeaway, Morgan.
Yeah, I mean, those to your point, the top line numbers for just the US business puts them, they were for a long time number one as far as their total revenue, and now they're number three. So that's quite a big change. And it's not like the others have been flying up, it's just they've been coming down because like Trulieve hasn't grown for a couple of years,
Mhm.
but they haven't shrunk like that. And GTI has just been slowly growing. And GTI, I should have mentioned that before too, is that GTI is very close now to Trulieve. I don't know if they'll pass them, but they're getting to almost parity on a top line number. Interesting about the spin-off of international. I think that's a interesting thought. Right now, that's a huge help for them from a top line perspective, even if margins are declining. And I'm wondering if the calculus is, the international looks like the US did many years ago, where you have these really strong percentage gains off of a low base.
Mhm.
Do they ride that until they start to see that slow down while they're hopefully getting their US side nice and sorted out? And then you spin off international so that international doesn't become a drag going through its cycle while
Hmm.
US is coming back. So maybe they're preparing for that eventuality, which will happen. It's inevitable because these international markets are just not that big. So there's only going to be so much growth. I mean, it could go for a while. I'm not saying that's like imminent, but maybe when Curaleaf International is 150 million or something of, and then it starts to go to single digits, and maybe margins are more severe than or less attractive than US, and they spin it out. Who knows? But if it's a decent position and they can sell that or list it in an international exchange and get some of that cash back, that could be an idea. The hemp thing doesn't surprise me because GTI is effectively already doing that strategy and running it, and so they're trying to build it internally a little bit more first, and then consider spinning it out if it does become something smart to kind of play both while we have no idea what's going to happen with either side from a regulatory standpoint. But it'll be interesting to watch all of that to see how the shareholder creation comes from kind of rejiggering of assets.
And when you think about the U.S. footprint versus like a Curaleaf or, um, I'm sorry, if you look at Curaleaf's U.S. footprint versus like a GTI or other, closer comps, do you think the weaker U.S. performance is more by the footprint itself or execution within that footprint? So do you think it's more about the states and the depth in those states, or do you think it's about the stores and the wholesale and how they're operating within those states?
Well, as a flower guy, I'm sure you would be thinking a lot about the quality that's being produced, right? And because they have wholesale, right? Any of these guys are vertical in these states, but they also have wholesale. And if you don't have great products, if you're not executing, on the back end, um, certainly doesn't help if your stores are not in good locations, as we always talk about. But if you don't have good products even put into the wholesale market, what's your mechanism is price, right? You just try to clear it. And that's really hard to keep doing over and over again and expect your stores to want to keep, your wholesale partners to keep taking product if it's not meeting certain standards or consumer demand. And
Mhm.
so you're just having to keep selling it very low priced. Um, there's just one thing that comes to mind. I mean, these things are tricky as it is, but it starts at the grow, right? You got to produce good quality product to then flow through the system, whether it's through your own stores, which is most advantageous from a margin perspective, and but wholesale is another way. And having effectively the ability to toggle between those depending on the pricing cycle and demands and everything. But it starts there. So I do wonder about that. I It's been a long time since I've had a Curaleaf product, so I can't speak to it. I just see what people are chatting about on Reddit and stuff like that.
Yeah, it's tough in California, right? Because, there's essentially no MSO flower in California,
Right, right. There's
right?
no one left. Yeah,
I don't think so. I
yeah.
think does TerraSense still have that small grow in somewhere in the Bay Area?
They
Um,
do. You're right.
yeah, and I've always heard that that facility produced some pretty good stuff, but Cresco is not here anymore. I don't think at all. Curaleaf, et cetera. So yeah,
Right,
in California, I feel like we have more of the brands. Like we had Ted on from Alien. Obviously, Glass House is big here, but your Cannabiotics, your Cams, a bunch of. It seems like it's more dominated by private brands here in California.
right, right. Jeter, for those that like flowery or flavorful terp stuff. Um, but yeah, um, trying to think if there's any other things that you didn't cover about them. Top line for the year,
Top
even
line.
with international growth, still looking at a 6% decline. This is for 2025 expected. So this is post the Q numbers coming out from analysts I've been plugging in.
Okay. Yeah, so it
Yeah,
looks like year over year across the board, looking back, was down 8%.
for the quarter, right? So
Yeah.
25 versus 24, still looking at a negative 6%. So that's it's tough. That's when you said what was it, 13% for year over year on the Q. It's really hard to chase that and drive better margins, right? I mean, that's a reverse operating leverage in full effect with double digit decline. So that's tricky. But if they can get that stabilized and our cost program starts to take hold, then it should start to stabilize a bit. With that said, similarly, operating cash flow for them for the year, again, I'm talking about 2025 versus 2024. I did see numbers go up there. And so that puts them at a year over year operating cash flow up 11.7%. So even with a top line number potentially down six, looking at double digit operating cash flow growth, which is obviously very helpful for managing the business, the balance sheet.
I think we've seen that in most of the reports, if not all the reports. What do you think is driving that higher operating cash flow across the board?
Hopefully, it's not unfound optimism that the pricing cycle is slowing. That this headwind that's been plaguing the space for a few years now is less meaningful, so that they can catch up with cost initiatives that could drive more operating cash flow. Um, I don't, it does seem from my queries to Grok and seeing like what Jerry's been posting and things like that. They're all still trying to talk, pretty tough on price, that it still is tough. And they don't see it abating, but if the rate of change is abating,
Hmm.
that would be meaningful. Um, so yeah, I was trying to pull their UTP before the call, but I'm guessing it's somewhere uh, high 400s, 480 of accumulated
Sounds right.
balance at this point. So that's like 90 million contribution, um, that benefits their cash flows.
Okay. You want to transition
So
and jump into Verano?
sure. So Verano, I do similar rundown for each of these that I did with GTI. Top line declined 9% year over year for the second quarter. Um, for the year, looking at a 7% decline. Their store count is at 157, so a lot of stores relative to their footprint, um, or relative to their revenue profile versus like a GTI, as I mentioned, 108 on 293 million. Verano's at 202 for the quarter on 157 stores. So quite a different mix. And I understand I'm just talking about retail because these companies can toggle, like as I was mentioned before, they can toggle between how much they want to lean in wholesale, how much they sell through their stores. So some quarters you might see better wholesale market numbers, and some quarters you might see better retail numbers. That can come back and forth. Operating cash flow for Verano is expected to decline 28%, 25 in 2025 versus 2024. So that is a pretty severe relative to what we were just talking about with these others. That's a big decline in money flowing through to the bottom line. Um, the uncertain tax policy is looking to grow by about 50 million for the year, against those numbers. So even with that operating cash flow down, and that's with not paying 280. So that's there's some big impacts on the business there. Total debt stands at 403 million against about 69 million of cash. And interestingly, Darren Weiss, who
Yeah.
was with the company for a decade, is leaving the company because he wants to do international cannabis. And it was interesting reading about that. And I thought he did a really nice, kind of farewell note. And I remember when people would be over at these European conferences and they would be like, Verano's here, Verano's here. It was Darren. And everyone was like, oh, that means Verano's going to go international. And maybe they were legitimately exploring it. And maybe they decided against it. And Darren's like, well, I'm still want to do this. So either we're going to do this together or I'm going to do it without you guys. However, it came to a decision, and so he's moving on. So that was kind of my takeaways from the
Do you,
quarter. I should note too that Verano, I did mention that. Okay, yeah.
it feels like to me, Morgan, that the perception and maybe reality around Verano has degraded over the last maybe say 3 years or so. I'm not sure if I'm quite right on that time windowing, but I think back to let's call it 3 years ago, a little bit different business, obviously healthier environment, more of a focus on premium products. I feel like back in the day they were known as um, Florida, Trulieve probably had higher margins because of Florida, but a real Verano thought of as kind of a margin leader. And it feels like the business, maybe all the businesses have degraded over the past couple of years. But do you feel like Verano has slipped a little bit more than most, Morgan? And what do you think has led to what I perceive as more degradation there?
So I'll leave the person nameless because it's not going to help for the conversation. But I remember a few years ago, someone I respect, a very smart person, one of the involved in a major company in the space, when Verano was being viewed super positively about their margins and everything. And he's like, dude, just look at their inventory levels. And look at how their inventories just keep building. He's like, so their numbers are not sustainable. And he nailed it. I mean, he was early in calling it, but he was trying to caution that there's more right there in plain sight that people are just not giving credit to. And I feel like that's been their story for the last few years. I think they've talked about it in this quarter, is the continued rationalization of inventory levels, and that's a big headwind to work through. To get the business right sized. I know their stores they used to be perceived as really high quality stores, which is why I did mention the number of stores relative to their revenue versus like a GTI number of stores relative to revenue. Um, it seems like they were all and they prided themselves on their balance sheet and prided themselves on owning their real estate and all these things that they were getting credit for. Maybe that was the time that they should have been taking more serious action. But how would you? I mean, this is again, this is all hindsight. How are we going to know that the cycle was going to continue to suck for so long, where they thought this was a balance sheet that was built for that next phase that
Yep.
did materialize, and so instead it just became a major headwind for them to have to churn through for a long time. I mean, they've had issues with quarterly statement filings, right? They've had to do restatements, and those are always tricky. I think people and some of the analysts that used to be in the space were maybe too willing to just be okay with that. I mean, usually that is a pretty big red flag for people. Is like usually want to be cautious when there's having to do restatements and refilings.
Yeah.
Um, and so it seems in hindsight like those were legit issues that were going to come back and be a challenge. So so yeah, the bloom is off the rose for them for sure. Um, question is how do they get it back?
Yeah, and also the stock has been absolutely murdered, right? Like, I don't have any numbers in front of me, but, of the top 5, it was just getting killed there for a while. So, on a valuation basis, maybe a lot of that has been, accounted for. But, yeah, they were really suffering there for a while on a price basis for the stock. And some of that could be due to unwinds. We were talking, I think it was before we came on the show about institutions leaving the space, and Verano was an institutionally owned name. And,
Right.
as some of these larger institutions left, I think they felt some of that selling pressure during a time when there was just, really no buyers of that size. So maybe, if you look at an investor, it's like it's one thing to make an observation like, oh, this business has been degrading, but then the question is like, how is that reflected in the multiples and the price of the stock? And so maybe that's accounted for in Verano. I think it's had some. I don't follow it super closely, but I recall seeing it's had a pretty strong, pretty strong rebound of late on the price side.
Yeah. But to your point, that was a double whammy of, challenging forward-looking company forced with a lot of, call it forced selling, call it whatever you will, but institutional selling, that'll make it catch up real quick.
Yeah.
And maybe probably overshoot. I don't know if that's fair to say. Is it rightfully cheap? Um, or where it is at this point. I think, as I was mentioning, just like the amount of operating cash flow decline, it's pretty severe.
Yeah.
So, and as I mentioned, the cash, call it 69 million to debt. They've had to really gear back on capex. Their budget's really, I think it was like about 100 million last year, and this year is projected to be like 40.
Yeah.
So, that's 60 million less they spent last year. So, with some of these names, it does bring back the old you can't cut your way to growth. And I do think that is generally true. But for us, I think there was a lot of overbuild that was okay to cut because it was just a drag. It wasn't driving any value. So, kudos to those that did take the hard cuts and continue to do so to right size, shrink to position yourself to grow again, but having the capability to do so. Um, so yeah, I mean, overall, to your point on a scoring situation, it's kind of in a funky place, I'd say, just because it's like with those kind of top line declines and cash flow declines, balance sheet. I don't, not necessarily concerned about a maturity situation, but just how they convert to cash and grow from there. So and we've talked about some of these companies that as you're going to cover Cresco next of like
Yeah.
the year of the core. That's just become a permanent mantra. Um, at some point you gotta like these others that are just improving their cash flow, throwing off more cash flow. That gets more interesting, especially if you're doing that without a ballooning tax balance. But
Yeah, that's a great transition into Cresco. And yeah, I remember I did the keynote with Charlie at Benzinga. I guess it was fall of maybe 2 years ago. And I remember Charlie said on stage that day, "It's not just year of the core. That's just who we are now." And I was thinking back, Morgan, was them not doing that merger with the cannabis like one of the best deals not to happen ever?
for Cresco, 100%,
Yeah.
because you look at cannabis ever since has been just liquidating assets and trying to figure out what works. Charlie would have been dragged down 100% with doing all of that work inside,
Oh,
and that would have really impaired their balance sheet.
yeah, and yeah, the whole thing would have just been so much more difficult. So I think that a good miss there, and I think everyone's been cutting for the past couple of years, but I don't know if Cresco actually has cut more aggressively or just been more vocal about it. But they were pretty ruthless on it gets harder on the each when you start cutting SG&A, your first cuts are relatively easy, right? The next cuts get harder, and then the next quarter you're looking for cuts. You're really trying to figure out like what can I do to squeeze more margin out of this business. And so I think they made some more drastic cuts, and they're continuing to refine that on the SG&A side. So high level, I think Cresco is doing a solid job managing the business, but I'll touch on the year over year numbers. Those don't look real strong in terms of especially things on the revenue side, but I think that they've done a good job of being proactive in managing the situation, and in this case exceeded estimates. So I'd say overall, decent quarter here for Cresco, especially relative to expectations. They pretty much beat across the board: revenue, margins, EBITDA. Revenue 164 millions, down year over year, but gross margins expanded to a bit over 50%. EBITDA margins around 25%. So again, the cost control is being helpful there, especially when we're looking at that EBITDA conversion. Net loss narrowed to 14 million, down from 51 million a year ago. 9 million in operational cash flow. SG&A is always a big talking point. It should, I always look at the SG&A number, but especially with Cresco, just because of that year of the core mantra that they had, falling to 32%, fell quarter over quarter. It's at about 32%, just over 30% of revenue. So doing a decent job there on the cost controls. Free cash flow is still slightly negative, at down about 3.8 million. I have in front of me. One of the big moves this quarter, they just refinanced that 360 million in debt, the new 325 million dollar facility. So it gives them some more breathing room on that. Let me scroll up to the year over year changes. Revenue year over year down 11%. Gross margin year over year down 80 bips, still trending right around 50%. Adjusted EBITDA margin down 422 bips. And opera, I don't have the year over year cash flow numbers. I'm not sure if those were in the report that I was looking at. But when we scroll up to the versus consensus, revenue slight beat, 164 versus 162. Gross profit pretty solid beat. Gross margin therefore a pretty decent beat. Adjusted EBITDA that came in at 41 versus I think estimates were closer to 33 or 34. Beat therefore on EBITDA margin. And so I guess when I look at it, if you look at the high level in terms of revenue, the year over year change being down 11% isn't awesome, but it feels like Cresco came into this with that expectation this was going to be hard. I think it's done a pretty solid job given what was in front of them to cut costs to deal with the more difficult environment that we're in.
Yeah. Yeah. I mean, it's, there's still, well, I got to plug in my numbers to double check all of this for the year. But, still looking at like just shy of a double digit decline top line for the year, 25 versus 24. So this is now multiple years of declines for them as they are trying to get their feet under themselves. So, you do have to wonder how many more years of those kind of declines do they have to go through? Because that's doing that for multiple years. That's a lot
Yeah.
to peel back.
Yeah, maybe one other point, you're talking about the flower side, Morgan, and as as Troy Datcher once said, growing great flower gives us permission to do other things. And I really love that quote, because if you grow great flower and you sell that in your stores, that's going to be awesome. You grow great flower, you make pre-rolls, those could be awesome. You grow great flower, you turn those into concentrates, those can be awesome. But if you start out by growing mediocre flower, I don't know that any MSOs truly grow garbage flower. I think there'll be different opinions on that, but I would call the term that always comes to mind for me as a big flower fan is uninspiring flower. Like, it's not going to hurt anyone, but it doesn't really get me excited to consume this. It seems like of this batch, Cresco brands continue to be really to be really strong. And it seems like on the branding side, on the product side, on the wholesale side, again, don't have access to those products in California. Sampled a bit when I've traveled and read the reports, but it seems like people continue to like the Cresco brands and products, which is something Ben talked a lot about on the GTI side. I guess that's another thing I could have mentioned back then. If there's another theme on the call, it was about the brands, yeah, the Rhythms, the Dog Walkers, the Incredibles, the Senoritas, really hammering home the success of those brands. I'd probably have to give Cresco some credit there, both in terms of building the brand, which sometimes I think about the brand part as being more like packaging, the perception, how you get a consumer to look at it and become loyal to it. But I think the biggest part of a brand is the shit actually good, right? Like, because cannabis consumers are smart. Like, I learned this when running a dispensary. You can sell something to anybody once by having a sexy picture and a great description, and in this modern day and age, high test results. Like that'll get somebody to buy something once, but people won't buy the same thing 2, 3 times in a row if you fool them with cool packaging and high testing numbers, but the flower isn't actually good. People are going to figure that out. And so I think that, again, when we're thinking about these different MSOs out there, the notion of growing great flower gives us permission to do other things, I think is important. And then just thinking like as a company, from a cost cutting perspective, Morgan, I'm always like wondering where does the cost cutting come from? Because if you cut too much costs, like I often hear on the cultivation side, people are saying things like, oh, we want to focus on the higher yielding strains. We want to focus on things that have shorter flowering cycles so we can, flip them more quickly. Or we want to, we want to use, cheaper lights and, cut corners like that. And that's a way to boost margins. But if you end up with bad flower out of that, you're shooting yourself in the foot. And, if you look at the retail side, there's smart things you can do at the dispensary level, to optimize payroll and employees, become more efficient on that side. But if you do too much of that, then you end up with a bad retail experience when you go to the store and you shoot yourself in the foot. And so I bet it's really interesting to be an internal person at like a Cresco, for example, and trying to figure out that puzzle of saying, how do I cut SG&A? How do I improve our margins, but continue to make things that people want to consume and continue to have a store experience, create places that people want to go to. Because if you screw up on either side of that, you're just, making short-sighted decisions where you're like, okay, well, I'm going to boost yields this quarter, but I'm growing stuff nobody likes, or flower that isn't good. Well, that's going to help for the quarter, but when people don't want to buy the flower next quarter, that's not going to help. If you cut too much on the stores and people wait in line for 26 minutes to buy an eighth of flower, well, that's going to show up well in the numbers once, but they're not going to come back to that store again. Instead of Sunnyside, they're going to go over here to the other store. And so I think that it's interesting to look at the numbers of the cuts, but then also think in your head, like, what's the strategic decision making around these cuts, and is it compromising other parts of the business?
100%. All I can say. Yeah. I mean, the thing is, like, and this is, I'm not talking about Cresco. This is just, we're talking generally now. But yeah, if you really cut the cost out of grow to the point where it's low quality, who are you competing with? You're competing with the pseudo cannabis, the hemp stuff, and then that pricing is brutal. Trying to compete with that, right? So I tried some hemp flower when during my trip. It's absolutely garbage. And I can't say I tried
Where
a
were you?
ton of different stuff. That was in New York,
Okay.
or it came from New York, and it was just like, it was awful. And I'm just like, but this is what people consume because it's cheap. They go buy it, it's cheap, and they're like, look, try this out. And I was like, I would never try this again.
Yeah.
But to your point, is like, this is where the MSOs in cannabis in general could actually have some differentiation from the low quality flower in hemp, the THC flower, whatever you want to call it. It's cannabis, just under a different name. But that's just going to be low cost. It's cheap. It's sold in gas stations. It's whatever. They blast it through it to get it on the shelves. Versus if you can have some nice quality product that you don't mind spending a bit more for because it's going to be a better product. And we've definitely interviewed some of these leadership teams over the years that if they do really care about that, it does show. and it comes through, and it's like the quality of your brand and the durability of your brand, and it makes me think of like Jason Wild because he cares like
Yeah.
that, and I think it shows. Ben cares. He's so people that
Well,
care.
what do those two people, those what do those two people have in common? Are the people that actually smoke weed, right? Like you get
Yes.
we interview some of these CEOs, and I don't want to ask the question, but if you ask them the question about like what was the your last cannabis product you consumed was, it was probably a tincture or an edible or something like that, which is fine. I'm not saying the cannabis CEO has to be a heavy stoner, but I think having a passion for the plant, I know Jason has done some homegrown himself in the past, and that Jason actually likes to consume weed. Ben, can't speak to his growing prowess, but Ben is definitely an enthusiastic cannabis consumer, and I think that stuff helps because I think you resonate more with the community that way, and you actually understand like this is a CPG product in some ways, but it also isn't because we're not making Big Macs where it's going to be the same thing over and over again. Cannabis consumers always want new things. That's another thing I remember from running the dispensary is people always want to try the new thing. Like they'll buy the Death Star OG once, Superfire, maybe they buy it twice. Almost never did I see somebody buy something 3 times in a row. Instead, it's always like, what's new on the menu?
What's
What's new on the menu? So you have to be a good tastemaker. Like you have to be tuned in to what people actually want to smoke. And then you've got to be able to decide, like, is this stuff actually good? And stuff actually being good doesn't show up in the test results. I promise you, you cannot look at a COA and tell me if the flower is good. Inflated THC numbers are too rampant. Same thing on terpenes. And even if you had accurate THC and terpene numbers, that's not all that goes into cannabis. The interactions with them are so complex. Tell me how the dry and cure process went. I mean, how much flower has ruined the dry and curing process? It's harsh. It doesn't smoke well. If you're in Illinois, what are we doing? Radiating things over there? Like there's just all these things that go into the process. And so we're getting off on a bit of a tangent here, but I think it's relevant. And when I
Yeah.
got into the industry, I thought naively a lot more was going to matter about who's actually making the best, who's actually growing the best stuff. I thought that would be a much more of a driver of success. And I think I overestimated that. But I think in the long run, that does matter because I think when we talk to the strength of brands, and I think you're smarter about this stuff than I am, Morgan. But when you talk about the strength of the brands, part of it is the consistency, part of it is the packaging, part of it is the image around it, but part of it is actually making something really good over and over again.
Yeah. It's just it's true. I mean, and it's really hard. I'm not, it's easy to say. It's another thing to do it. And I think to your like this ties back to our comment about the qualitative assessment of management, though. And that's why I do think it matters. Is like how passionate are they? Like, do they want to consume it themselves? Are they embarrassed if there's a bad batch that comes
Right.
through like that, like really irritates them, gets them angry, and makes just as unwilling to accept that kind of output because they understand how damaging that is. Like that's very different versus just like, oh, we'll just blast it through, just bogo it, dump it, who cares? Instead of being like, no, this is unacceptable. Like Jason's taken down a whole grow if he
Mhm.
was like upset with what was going on in it. Like, how many guys will do that? How many people in this space? Not many. So yeah, it's a qualitative assessment of management, and I do think it does matter. And I don't know how long it's going to matter, but it does. I mean, and this is where the hemp beverage thing does kind of this where it does kind of have a little bit of staying power because it's really is just an ingredient, and you're not so worried. Other than you still want it to have
Mhm.
a consistent effect. You don't want to have a ton of variability in the effect in the cans that you're putting out to people. But I was going to tell another story when I was at a party in New York. Um, they were passing around gummies and they procured them from a legal store. It was on the reservation where it came from. But where do those gummies originate? From Minnesota.
Oh, really?
Yeah, I was like, "How did these get here?" And they're like, "What are you talking about?" I was like, "These say Minnesota on them." And they're
That's
like,
funny.
"So?" I was like, "That's not okay." So,
Were they
um,
some of the hemp derived ones, I would imagine.
um, they probably were. Yeah,
Yeah.
yeah. And I felt nothing. One person got really affected,
Hmm.
and so like super variability. So to that same point, I mean, it was like that. I was like, I'm not a gummy guy anyway, but I was just like, what the heck, I'll try it because I haven't had a gummy in a while. But I was just like, see, this is why I never have it because like they were complaining about how like one of the guys was like really not happy with. He's like, I that was like a 3x effect than what I was expecting. Like,
Mhm.
Yeah,
Yeah.
don't know.
Theoretically, I think those products are easier to get right consistently. At Leaf, we're currently we're in California. We just closed on our New York license in June. We're just sliding our equipment into our New York facility, and we'll be cranking out oil in New York soon. And we have a lot of California brand partners, which are also leaders in New York, especially on the edibles side. And I always think about edibles as being the ones that are probably easier to build a national brand with because you can get the same, similar chocolate, similar gummies, hopefully similar oil, although the oil value, the quality of oil does vary. But if you're using distillate, for example, you should be able to source close, similar enough things and be able to create, a national brand of edibles more easily. I think that gets even harder on the flower side. I think we talked about that with Ted from Alien, right? About and Brady, we've also talked about it. I think Brady used the term using a California playbook and going to Florida and failing for a couple of years while you learn how to grow flower in Florida. And so, yeah, it's really hard to produce consistent products across the country. But as it relates to the edibles, because it's Minnesota, it doesn't really fit the narrative so well. But I would be curious if you took, some of the national, the Kivas, the Wilds of the world, and you took a product in, New York or Illinois, and you compared it to the product in California. I would hope those could be substantially similar.
That's the theory
That's the
of why
theory.
they do it. But to your point, is like, yeah, it should. But if you talk to any of these brands, the biggest challenge, and I think you guys are aware of this too. So I'm not saying anything that you're not aware of, but it's like it's really hard to have brand partners that can meet your quality. So even if it is an input, like you still need to make sure it, and like their mixing processing and everything
Yep.
is doing it so that the effect is similar enough. So the taste profile is similar enough. You don't want one to be more bitter than the next, and you don't want one to be getting you blasted and or not.
Yep.
You want to know if you're going to get a little bit high. If you have a 5 milligram kiva, um, you know, gummy, and you do it in California versus New York, it's going to be the same thing.
Yeah.
So
Well,
yeah,
let's wrap things up with some
yeah,
takeaways here, Morgan, and I'll lead off this one, and mine is going to be fairly short. And I think back to the conversation we had with last time Nick Gastovich, and shout out Nick. He is having his first child and taking this earnings season off. So glad to see him getting some rest, and congratulations on the kid, Nick. But I was thinking about the conversation we had with Nick, and it must have been maybe 6 months or so ago. And what we talked about was that the absence of new states turning on. So we didn't get Florida, we didn't get Pennsylvania yet, obviously didn't get Virginia this year, essentially no new states. And in that environment, a couple of things happen. One is you don't see much top line growth, and we're seeing that. We're seeing top line, declines in most cases. And the other thing is the associated margin pressure that it can put on things. Because when you have a new state flip, like if a Florida were to have flipped, or if and when a Pennsylvania flips, typically prices go up and margins increase for a while. So you have the revenue boost and you get the margin boost, while most of your other footprint, maybe not all, but generally most of your footprint continues to degrade or normalize depending on how you see it. And so I would say this quarter to me was not surprising on a top line basis, given the environment we're in. I think that was pretty predictable. I would say execution this quarter in terms of translating that into margins, which lead to EBITDA and ultimately flow down to cash flows. I would say that most of that came out, I would say, better than expected. And I'd say the third takeaway, Morgan, is we've seen a huge shrinkage in the analyst coverage out there. And maybe that's done too. That maybe there's, and I think at the same time, you've seen estimates get more realistic. So maybe that smaller group, like the Aarons and the Fredericos of the world that have been around, for years, some of the sharper ones, maybe the ones that are left. And I think just generally the expectations across the industry are more realistic. And so maybe that sets up a potentially interesting thing if we get our Goldilocks scenario where we get reform. Let's say we're fortunate and something like Schedule 3 happens later this year or sometime before midterms next year. And if we can flip a couple of states, if we can get the Pennsylvanias, the Virginias of the world, Minnesota will hopefully turn on in the next, 6 months or so here. Then we could come into that with expectations, maybe not being low, but expectations on the analyst level looking more realistic, operations getting leaner out of necessity, and I think people finding religion around cost controls, and then pairing that with revenue growth, which would come from adding some new states. We'll see what happens in the hemp channel, and then potential margin expansion, based on reform. And so I would say, overall, I felt a little bit better than expected so far through this earnings season. But I think it's important to realize just because they're seeing a lot of beats on expectations doesn't mean these are actually sexy prints. They're just kind of not as bad as I expected them to be.
Right. No, I think that's the idea that they finally have gotten numbers down so that they are meet or beatable in some aspects. I mean, you want to see them beat on all aspects. So, there's still some fine tuning to do. I really hope Federico doesn't leave anytime soon because I do think he's one of the last remaining that's worth reading when it comes out. So, because it's very quiet out there. I think this quarter, as we mentioned a little bit earlier, my takeaway is it's just becoming, there's almost now three buckets. Before it used to be not reform dependent and reform dependent, and now there's a third layer where it's just too far gone. So if you fall into the reform dependent, you can hang in there for a bit, but if we don't get any further, you're going to
Yep.
drop down to it's too risky. Like, just don't even touch it. And I think there were many that were hanging into that reform dependent, but I think we're starting to see more that are just falling out the bottom, and it's taken a long time. And I know I've said that many times. It takes a long time, but if the strongest that have been better at not getting over their skis and have been managing their costs better, got religion sooner, can be the beneficiaries of those that are finally clearing out of the system, that it creates more growth to them. Because the buyers are not going to go away, hopefully. They're not going to divert. So if they want to stay purchasing in the legal channels, then those that survive will capture that market share. And that is a benefit to those that can survive.
Yep.
So I just think this quarter is just another instance of how much this is really separate. The dispersion is the word you used before, and it's perfect. I mean, it used to be a lot tighter, and it just keeps getting bigger and bigger and bigger. Because I don't think AYR by any means is the last. I think we'll see more of them. And you just, and that's why some of the KPIs I was trying to put out there and in my rundown, just like the final bullet point was total debt relative to cash. And I think that's just a key metric just to keep an eye on for those that might fall into the really sensitive area, especially if you're trying to play in the common stocks, because it's like, I understand you could make 100%, but is it going to actually transition into a real business? Or, you know what I mean? It's like, don't let a trade turn into an investment kind of thing. Same thing if you get it wrong. Because some of these things could trade around like they do, but just some of them might do that before they go to zero. AYR is a perfect example. I mean, that thing would go up 100%, 200%, and drop down 50%. You know what I mean? Like, that thing was all over the map before it ultimately did what it did. So
Yeah, Forefront did a bit of those spasms as well.
yeah, because people are speculating, and I think Leafly could probably fall into that bucket, but you see that thing still whip around quite a bit.
Yeah, I forgot about that. I used to go to Leafly fairly regular if I was going to have some flour and I wanted to look up like what are the genetics of animal face and what might one expect the feelings associated with consuming said animal face be. And I've actually been throwing those into ChatGPT more and getting information. So I wonder.
Oh,
Yeah, so I hadn't really thought about that with Leafly, but on the AI side, I wonder if that's going to make that harder as well.
that is a fantastic question, because when they were trying to do some things, they did approach us, and that was one of our big risks, was like, how does AI not just completely destroy their revenue profile? Like,
Hmm.
how do you land into some place that does not just get eaten up by that? So,
Yeah.
and that was a very good question that we were debating, and that was quite a while ago now. So yeah.
Well, Well, shout out to our new listener here, Jonathan. Jonathan had made a comment that I love. He said, "Wow, I stumbled onto onto this podcast. This is actually a serious podcast." That made me laugh. Good to have new listeners. Tells us there's maybe some new folks out there. And yeah, man, it's we try to have a good time, but yeah, we try to prepare and show up and do a real show. So thanks for listening, Jonathan. Appreciate that.
Yeah. Shout out to Nick, by the way. Congrats to him and his wife and their
Yep.
new baby. And we'll let him slide this time, this quarter. It's okay. Next quarter, we
Yeah.
expect to have him back.
Yeah, hopefully, yeah. Next, so we'll put you on the books. We'll be bugging you. I guess that would take us into what November next. So you have 3 months to enjoy the family a little bit.
That's right.
You want to take us home with an Ask Rock?
Sure. So I wanted to test Grok versus our own conversation of our analysis and things we were talking about. And so I asked Grok, what are your top 3 takeaways from the Qs that have been reported so far? And Grok's response, based on the 2Q reports from major operators, the sector shows resilience in a challenging environment marked by price compression, regulatory hurdles, and market maturation. And the 3 points were mixed revenue trends with overall soft growth. Most MSOs reported a flat to declining year-over-year revenue, primarily due to wholesale price pressures, competitive dynamics in mature markets. Noted that there's a focus on margin expansion, operational efficiencies. Despite revenue softness, many companies improved gross margins and adjusted EBITDA through cost controls, vertical integration, and efficiency gains. And the third point, strong cash flow generation and balance sheet fortification. Cash flow from operations and free cash flow emerged as highlights, enabling debt management, share repurchases, and expansions. Those were Grok's comments, not mine.
Yeah, pretty good. I've been toggling a lot back and forth between Chat GPT and Grok, and I feel like lately Grok's been better for me. It's been faster, and I've been liking the results more.
Grok 4, which I've been using, is great.
Yeah.
I almost never go to ChatGPT anymore. I do all kinds of things in Grok 4, just like it's like anything else. So because I pay, that nominal, was it $70 a year or whatever it is.
Do you
So,
pay the $20 for the fancier chat?
I just paid 70 for the year, so whatever that gets me.
No, for Chat GPT.
Oh no, I don't.
Okay.
Patrick he does do that. So we do get to compare. So I pay for Grok, he pays for ChatGPT. You know what I mean? So we kind of play around with the different LLMs.
Yeah, I pay the $20 a month for chat, and that improved it quite a bit. I think you get better models, and it'll spit out more documents. Like if you wanted to output a spreadsheet or wanted to output a PDF or a Word document, it can do that. So I don't
Nice.
know. I don't know that you need both. But if I didn't have the premium chat, I would just live on the Grok side. But even with the premium chat, I kind of bounce back and forth, and sometimes one is better than the other. But lately, been leaning into Grok more.
Yeah.
Well, cool,
All
man.
right.
Good conversation. Always to catch up. We're an hour and 38 minutes in. When we started the show behind the scenes, we said, "Oh, I think we'll go for about an hour," but here we are, 40 minutes over the hour. But good conversation. I enjoyed it.
Yeah, that was great. And I can't believe it's been an hour and 40. It's a good show.
Cool, man. Well, time flies when you're having fun. Appreciate talking to you, Morgan. Appreciate all you listening, and we'll be back again soon. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor recommendation. All investing involves risk, including the loss of principal.